Well, good morning, everyone. It's morning everywhere, unless you're on the East Coast. And Happy New Year. Today's webinar is really all about numbers. Ken and I are not going to try to hit you over the head with numbers. I promise you there will not be a quiz. If you've been following along in your emails that we send out, you will notice that there is a hyperlink that allows you to download this key financial data card that we're going to reference at a couple points in today's workshop. In addition to that, I do strongly encourage you as well to reach out to your advisor, whether it's me, Ken, Jason Dufault, and schedule a time to do a little tax prep. Taxes aren't due for a while. And if you're one of those people that files an extension, taxes aren't going to be due for another 8 or 9 months, which gives you time to do a little bit of planning. Just know that, and we'll talk about this, just know that if you're going to do a Roth conversion, or excuse me, Roth contribution, IRA contribution, things like that, you got to get it done by the time taxes are supposed to be filed, which is in April. Okay. So just keep that kind of stuff in mind. You got time to do things, but some things still need to get done on time.
Yep.
Um, we're not going to go, we will not go more than 45 minutes today. I promise you. Ideally, we'll land somewhere around 35, 40 minutes because this could get really dry really fast. I do want, by way of introduction, though, for you to take 2 or 3 key ideas out of today's workshop. The first thing is we wrote this book last year. See, there we go. Maybe over here is better. I don't know. We wrote this book last year, and it is called The 5 Pillars of Financial Freedom. Good job, Ken.
Yeah.
Pillar 4 is tax planning. Okay, tax planning. If you don't have a copy of this and you want a copy, let us know. If you're an Amazon Kindle person, go ahead and download it off, get it into your Kindle library and read it. It's a quick read. It is not meant to be a textbook. Okay. It is meant to give you ideas that you can take action on. But pillar 4, tax planning, make sure you're just educating yourself. The second thing I want everyone to take out of today's workshop is your taxes are driven by really 2 key things. One is income, and 2 is the asset type. So income is income. We know that, right? Unless you're in retirement, your municipal bond income, or you've structured some kind of insurance income where there's really, or Roth income, there's no taxes. Income, though, is going to drive adjusted gross income, or more importantly, for, say, Medicare premiums or Social Security taxation, modified adjusted gross income. So that's income, right? That's going to drive it for you. If for those of you in California, you're lucky enough to get hit at the state and the federal level. From an asset standpoint, though, an account standpoint, though, asset location in many cases matters more for investment return than the actual return itself did. What do I mean by that? A few years ago, I had a client who had a mutual fund, really good mutual fund from a really good company. And it wasn't huge. It wasn't huge. But she wasn't buying or selling this mutual fund herself. She wasn't doing it at all. Okay. This was just a brokerage account. It wasn't tax deferred in any way. This mutual fund, all by itself, was costing her about $6,000 a year in capital gains and income tax. 6,000.
Mhm.
I don't know about you, but for me, if I see a $6,000 tax bill for just about anything, my stomach drops and I'm like, what happened? Like I get that you can get a big tax bill. I understand, but I really want to know what happened. What caused her tax bill to be so big? The mutual fund manager wasn't doing anything wrong. The manager was doing their job. They were trying to limit losses, maximize return. And what they didn't realize they were doing in the process, because it's not their job to think about your tax bill, what they didn't realize what they were doing was they were destroying the return if you factored taxes in.
And so, Matt, I'll ask, are there mutual funds or investment strategies that would have seen the same level of growth and taken that tax bill from 6,000 to 1,000 or even 500?
Absolutely. Absolutely. And see, that's the thing is when all of us, it doesn't matter who you are, when all of us are looking at this stuff, we all get sucked into, oh, the return was this, the return was that, the return was this, the return was that. And then the tax bill's late enough, further enough down the road, we don't even think about it until it hits. Then we get mad, at least I do. Then we get mad, and we're going to make a change, and then we calm down, and it doesn't happen. And then next year, the same thing happens, right? To Ken's point, if I'm getting a big tax bill generated by something, I at least need to review it and learn what my options are, so maybe I can minimize that in the future.
Mhm.
So that's part of the reason of making sure that we're going to educate you today on key financial data. And again, just throw it in the chat if you'd like a copy, right? We'd be happy to send one out to you. But Pillar 4, tax planning. And again, I promise you, it's not a textbook. It's not like reading a Dan Brown novel, but at the same time, it's a quick read. And it's actionable stuff. So, all right. So let me share my screen, unless I already am. All right, let's jump into it. Okay, Ken and I are your hosts. You can see all the disclosures at the bottom of the page there. All right, Ken, talk to us a little bit about tax brackets and rates and what people should be thinking about. Maybe, maybe they're married, but maybe they're going to be single at some point. What do they need to be thinking about?
Perfect. So the most important thing when we're talking about tax brackets, there are two kinds of taxes. There is what I would call a cliff tax, and then there's a progressive tax. Cliff is the cleanest and something we deal with every day. Our sales tax is kind of a cliff tax. Is no matter what the transaction is here in San Antonio, it's what, 8.25 or 8.75. It's what it is, no matter on the whole amount of whatever the transaction is. And then there's progressive taxes, which is the first dollars you make are taxed at a certain rate. The next dollars you make are taxed at a new one, and it progressively gets more and more expensive the more you go. For the most part, when it comes to federal and state income tax, which today is focused on federal, they are, for the vast majority, are progressive taxes. So we're going to take a look at the single brackets. So the first 12,400 for a single individual is taxed at 10%. So if you see, let me see if I can get my laser going. Do do do. Nope, not yet. Oh, there it is. Maybe my arrow. Can you see my arrow, Matt?
Mm,
Nope, turn away. All right, never mind.
nope.
So
What do you want
if
me to
you
point
look
at?
at the 1240. So if you look at that first $12,000 that you make, you're going to owe 10% of that. So that's the 1240 that you make. Now, for all the dollars you make above that amount, upwards to 50,400, you're now at the 12% bracket. And cumulatively, you would have paid $5,800. And so now that you make $50,401, technically you're at the 22% tax bracket, but it's only that $1 above that is taxed at 22, and all the dollars below it are taxed at 12. So yes, you're in the 22% tax bracket, but your effective rate is significantly less, because majority of the dollars that you made at that 50,401 are taxed at 10 and 12%, and it's only that next dollar that is taxed at the 22. And then it goes all the way up to 105,000 for the 24%. Now let's hone in on this. The 24% tax bracket for single individuals goes up to 105,700. And then everything above that is 32, 35, and 37. Now, Matt, go ahead. Remember, 105, 700. Now let's go to the next slide.
Yeah. I will catch up in a second. There we go.
Married filing jointly. It goes from 105 to 211. A lot of the people I see on the call are currently married, filing jointly. So your 24% tax bracket goes all the way up to 22% bracket goes all the way up to 211. And your 24% bracket goes all the way up to 403. Most of y'all fall into that category. There's something that might happen in your life, the big D's, death or divorce, that now might put you back in that previous chart. And if you're here, you've done good planning, but imagine the people that have pensions, they have real estate or whatever it is, and it's generating the income they want and need in retirement. And now they switched from married filing jointly to now that they're filing in the single brackets, and their taxes just went up significantly. Not because they're making more, but because their tax rules have changed. And so, as Matt opened the conversation of how are your assets being taxed? Are they what we want them to be, where we need them to be? And what are some of the changes in our life that might happen that's going to make these even more taxable? Are there things we could be doing today and tomorrow that, if those events happen, keep us in the lower brackets?
Yeah, and I would just add a couple quick things. One is Ken mentioned the big D's. In the event of a divorce, your marital status at the end of the year is going to determine how you file. Okay, so if you've got a divorce that's wrapping up in late November or something like that, it might make sense to maybe have it finalized in early January, if at all possible. If your spouse dies, though, it's a different set of rules. You can still file as married in the year your spouse dies. There's also an extension on that you can get. The challenge is if, and this doesn't happen too often, but somebody's spouse dies and then they remarry in the same calendar year. If that happens, the challenge isn't so much for the person who got remarried, it's for the person who died. Because guess what? There is still a tax return due for that person. Okay. So just keep in mind, just because you remarried and your spouse passed away does not mean that the spouse who passed, Uncle Sam or the IRS has forgot about that person. They haven't. They're
Mhm.
still having to file a return. So that's happened a couple times, with some of the households we work with. Just want to make sure that you're aware of that.
Yeah, I'm gonna
Go
lean
ahead,
onto
Ken.
that just a smidge more with that 1231 date. If we had clients, not this previous 1231, but the one before that, leading into 2025, they were scheduled to get married this May that passed. And when I talked to them about their taxes, and both of them were single, and this is a silver marriage, so both of them getting married later in life, say, hey, but both of y'all switching into the married filing joint brackets, y'all will save about $25,000. Next thing I knew, they emailed me a picture of their marriage certificate. They went down to the courthouse, got hitched, locked it in for 2024, had their ceremony in 2025, but they were able to save some tax dollars. So it works both ways in both marriage and divorce. The 1231 date, however your status is at that point, is what's going to apply for the previous 12 months. So thanks for bringing that up, Matt.
Yeah, you bet. You bet.
Yep.
Okay, we do get questions every now and then as well because we do some advanced planning with people. How do estates and trusts get taxed? Similar concept, but the thing I'll focus on here is the numbers narrow dramatically. You get over $16,000 of income, you are in the top bracket when it comes to estates and trusts. So for those of you who are dealing with wrapping up an estate, do it quickly. Do it quickly. Okay. And that's something that when we get into estate planning with people, a lot of times we talk about the importance of having a bank or a trust company involved in that process because they do know how to wrap things up quickly, right? They're not trying to blow up the tax bill for the estate of the person who passed away. So estates and trusts, same concept, but it's a much smaller number that you get drilled on.
It can,
Ken mentioned,
and
sorry.
there are different kinds of trusts. And so again, it's a word that is this all-encompassing thing of I have a trust. Well, there are trusts that follow that exact bracket that Matt was showing, but then there are also some trusts that follow your tax bracket as a household. And so when you're thinking about your estate plan, making sure you know what assets are being left behind are going into the trust, but what kind of trust and what kind of taxes are your beneficiaries exposed to with it. So again, if you have questions, want clarification, it's a perfect talking point for us.
Thank you, Ken. I'm going to talk standard deductions and then Ken will talk capital gains and dividends after that. But from a standard deduction standpoint, Ken mentioned this earlier, cliff versus a progressive system. The standard deduction is essentially a cliff system. Okay. So if you're married filing joint, which you can see on the top line there, and you're under 65, your standard deduction is $32,200 going into 2026. So what does that mean? What that means is all the deductions you can normally claim, which people will talk about itemizing, if all those deductions add up to less than $32,200, your deduction is $32,200. It's just what it is. Okay. You give 5,000 to a charity, and it still adds up to under $32,200. You don't get any tax benefits from that. Okay. Because your standard deduction as a married couple is 32,200. Now you go over that limit though, now you're itemizing because you're over the standard deduction. If you are a small business owner, if you have an LLC, if you have an S corporation, one of the things that your accountant or your tax professional should be doing is encouraging you to track mileage. Make sure that you're using like a dedicated, like an American Express card. You're using QuickBooks. You're using something to track your expenses because all those little expenses during the course of the year, they add up tremendously and they can lead to a much bigger deduction than a standard deduction. Okay. So if you own your own business, S Corp, LLC, that kind of thing, just, make sure you're aware of that. I mentioned before 65. Okay. So there's additional standard deductions if you're 65 and older, or if you have, vision issues. One thing that's been a little misleading, maybe in terms of the language that's been used around the big tax bill that got passed last year. The big tax bill last year, and we'll talk about this later as well, did not change how Social Security taxation works. What I mean by that is when you're retired and getting Social Security benefits, the formulas are still the same, the thresholds are still the same, but now there's this additional $2,050 deduction that you can take, and that's only good for 3 years. Okay. For some couples, that extra $2,050 deduction is enough to pull their tax rate on their Social Security income down to either a 50% or a 0% number. Most of our clients aren't going to have that issue, okay, because their income is too high. But when you see, like I saw a statement yesterday, we're not taxing Social Security anymore. Well, yes, you are. There's a deduction now, and for some people, that means that their tax rate changes. Child tax credit, okay, $2,200, $1,700 is refundable. There are income phases or phase outs on this, and you can see the numbers there. Income phase outs, doesn't matter, what provision of the code you're talking about. When you see an income phase out, it basically just means the more money you have, the more restrictions on it. Okay, that's all it means. So income phase outs begin at 400,000 joint, 200,000 for every other type of filing class. All right, Ken.
Yeah.
Capital gains, qualified dividends.
So let's just first define what is a capital gain. I bought some real estate for 100,000, and it's raw land. It does nothing. 5 years passes, somebody offers it to me for 150,000. I sell it. I had my capital grow. It gained by 50,000. I get taxed on only the growth. So on that 150, 100 of it is return of capital, and then the 50,000 is growth. Same thing is true for stocks. I bought Coca-Cola at $100 a share. It's now $150 a share. If I've held it longer than 366 days, it is a long-term capital gain. So for 1 year, it is now taxed at 0. 15, or 20. But which of those rates? It depends upon what my household income is as single, joint, or head of household individual. So if we focus on the middle column, is if your income is above 98,900 collectively, this is one of those cliff taxes. All of your capital gains are at 15%. If it is below that amount, well, now it's zero. Now, again, there's a lot of caveats to exactly what adds up to get you to that 98,900. These are some of the numbers we crunch when figuring these things out for clients, but zero is pretty nice. And managing your taxes and keeping them at that 15% or lower is going to be key. If it gets too high, or if your income starts exceeding certain thresholds, now we're exposed to the 20%. This is one of the reasons why we talk about Roth conversions and making sure we see the full picture when we do it, because in years that we do a lot of Roth conversions, we might be exposing ourselves to an extra 5% of our capital gains. Not saying that we shouldn't do that large of Roth conversions, just means we need to be aware of all the different taxes that are to be triggered. Next slide.
Ken, loaded question for you. So I bought and sold a bunch of stuff in my IRA. Oh my God, am I going to owe capital gains?
Beautiful question. Absolutely not.
What? How come?
Because it's a tax shelter. So because it's within a 401k, because it's within an IRA, even annuities or life insurance, there is a tax wrapper around it that you can do whatever you want inside of it. You only get taxed as income when you take those dollars out and you put them in your pocket. If you go from IRA to IRA, it's a non-taxable event. It stays within those shelters. It's when they receive them in your hand. So this is explicitly for non-retirement accounts. Thank you, Matt.
You're welcome. Thank Jeremy.
Of course.
Yes.
So then next slide.
I will pay attention now. Okay.
There you go. So what is the alternative minimum tax? So Matt was talking about a lot of deductions. Especially as business owners, there's a lot of reasons why you might qualify for deductions. But if you start doing too many, there might be what's called a minimum tax. So as long as you're not deducting over $140,000 a year, assuming you can back it up to the IRS, and if you ever get audited, the brackets we talked about before applied. If your deductions are above that $140,000 limit, you can have a whole separate ledger called the AMT, or the alternative minimum tax, that you might be exposed to. And the same is true for single, married, filing separately, or estate and trusts. But we probably deal with that maybe just 4 or 5 times a year. And it's all about just keeping track of your deductions. And not that AMT is bad, it's just it's more forms you got to file and see what your fair share is of those payments. Next, okay. So back to taxes on net investment income. So if your modified adjusted gross income, so there's your income that you have coming in, there's a separate calculation to calculate your modified adjusted gross income. And if it starts exceeding different amounts on top of those capital gains that you're paying, there might be an extra 3.8% on top of it. So we'll just talk worst case scenario. Married filing jointly, you make $400,000 a year of income. Well, that already puts you into the 32% tax bracket. It's pretty much right at that line. All of your capital gains at that point would be at the 20%, but then with this extra seasoning on top of 3.8. So your taxes on your capital gains are now 23.8%. But I'd remind you, your income is at 32. So if you had a choice, would you take more income, more money from an IRA, or, hey, boss, give me that bonus check? You're going to get taxed at 32% just on the federal level, not including state, but on the federal level, or 23.8. 23.8 is still a better, lower number. So it's not the worst thing in the world, but it's additional dollars taking away from your overall return, and just got to be aware of it. Matt, you want to take gifting?
Sure. So gifting and estate tax, there are some exclusions there. I would say that the biggest, I wouldn't say mistake, but the biggest thing that people get in their heads when they see some of these numbers, like the $15 million gift tax exclusion, is that estate planning does not apply to me because I'm going to pass on less than 15 million. So who cares? Right. Keep in mind that 15 million is per person. So you take a married couple, it's actually 30 million. Okay. So where estate planning will still fit in, and a lot of you have heard me talk about this, you still need to have, in many cases, a will, a trust, a medical directive, and a power of attorney. You still need to have those things. The will, why the will? The will is going to pass stuff through probate. The trust will bypass probate. Things that are actually held in the trust, the things you use to fund the trust, will pass without going through probate at all. Medical directive, durable power of attorney. Hey, if that big $15 million account is in my name and my name only, Ken, and I'm laying in a hospital bed and I can't make decisions for myself, who can touch my $15 million legally?
Nobody.
Nobody
Just you.
can. Just
Just
me.
you.
Yes, just me. And I'm laying in a bed and I can't make decisions for myself at that point. When Prince died, the guitar player, right? The artist. When Prince died, he had like a $300 million estate, way over these exemption limits, right? Way over them. No will, no trust, no nothing. Nothing. They're still litigating. Okay. So you see these big numbers, and a lot of people they tune out when they see the big numbers. Don't tune out. Okay. There are still planning considerations you need to think about, even if you're not close to this. If you're over this or you're, I would say in many cases, 5 million or more in total assets, you need to be thinking about some of the different estate planning strategies you could employ, not just to minimize taxes today, but to minimize taxes to your heirs, which the IRS calls income in respect of a decedent, IRD taxes. And of course, you can have a huge positive impact on people through charities you want to work with. So, from a planning standpoint, do not get put off by these numbers. There's still work to do. These are just the raw numbers in terms of where some of the thresholds are.
Can I dig a little bit deeper on gifting?
Sure.
So people also see this number of say 19,000. So I can only gift $19,000 a year. The answer's no. You can gift more. You just have to disclose it to the IRS. But all of this comes back to the estate planning conversation. So let's talk about that $100,000 rental property that you have, and you want to give it to one of your kids. Well, if you give it to them, you would just have to fill out the form and now file it for taxes, and eventually there's a process for it. So you can give more than 19,000. But what happens is your cost basis also transfers to them. So you bought it for 80,000. It's worth 100. You fill out the documents. The client now, your child now receives it. They sell it for 150. Remember, you would have been only taxed on the growth. Well, they are now fully taxed on the growth that they've experienced. So from 80 to 150, even though they got it at 100, their basis of 80 transferred to them as well. Now, had you passed away and they inherited the property, they get what's called a step up in basis. So that 80 went to 100, they sell it for 150, they're only taxed on the 50 versus the 70. Again, it's neither good nor bad. It's just the way the system is set up. You can give and transfer assets above 19,000s. There's just a process and there are implications. Are those implications good or bad? That's up to the circumstances to define.
All right. Education credits. American Opportunity Tax Credit, $2,500. Okay, it does phase out. So you're going back to school, check to see if you're eligible. You kids, just make sure you check. It's free money. essentially. Lifetime learning, keep in mind in a given year, you can't take both for yourself. You have to take one or the other. Okay. An individual can get one or the other in a given year. They can't take both. And then education accounts. Okay. This is Coverdale, which isn't, or Coverdell, I guess, which isn't as popular as it used to be. It's still out there. I think what a lot of people tend to look at is a 529 plan. One of the big changes is 529 plans can now be used to help fund K through 12 education. You can take up to $20,000 a year. In addition to that, there is also a new provision that allows, and you can see it in the bullet point there, that allows for 529 distributions to be used to help manage student loan debt. It's 10,000. It's a one-time distribution. If you pull money out of a 529 plan for things other than qualified expenses, qualified education expenses, it is a taxable event at that point. And in most cases, it's an additional 10% penalty as well. Okay, so from a 529 plan standpoint, they're great tools to get tax deferral on accounts that grow to help fund education. There are limitations, there are structures around that really do work to make sure the money just gets used for education. Okay. We don't have a ton of time to get into 529s. I will say this. If you're thinking about college for your kids, grandkids, whomever, you're going to want to make sure you're working with a professional college advisor, because the professional college advisor can show you, hey, you know what? It's great. And they won't really care about the 529, but they'll say, great, you got 200,000 in your 529. They'll say, wait a second, here's a school that fits your child's strengths and they can really flourish at. And oh, by the way, the merit aid they give is 3 times the merit aid that you were thinking about, that you were going to get from the school that the kid's thinking about. Your high school guidance counselor doesn't have time to do that at all. They're more of a therapist. So when we're thinking about 529 plans, they're great tools. But like we talk about with everything, stretch the dollar as much as you can, because money that's left over in 529s can then be passed on to the next generation or to siblings as well. Okay, retirement plans, I'll touch on these, Ken. This gets back into asset location as well, right? A lot of people, when they're working, it's put as much into my plan at work as possible. Choose the index fund that's, large cap equity and let it run, right? Let it run. And I wake up 25 years later and I've got a ton of money in here. And oh my God, I'm going to have a huge tax bill because all that money came out into these retirement plans as pre-tax dollars, which means you never paid a dime in taxes on it. Did that help in the short term to lower your taxable income in the years that you were contributing? You bet. Did it also create a big tax bill for later on? Yes. Okay, so you can see there's a whole bunch of different plans here. We're not going to get into those today. It would just overwhelm. And if you have questions on this, let us know. One thing that's gained in popularity, though, is Roth 401k, 403b, 457. Those are relatively new, last, I don't know, maybe 5 to 7 years or so. Given US debt, and given that overall, even though it doesn't feel like it, we are in the lowest tax environment we've lived in since the 1920s, you do want to take advantage of those Roth options while you can. There's, some congressional committees at the federal level are already talking about ways to limit the total dollar amount that ends up in Roths, because the federal government wants your tax dollars. They do. Doesn't mean they're not going to I don't think it means they're going to get rid of Roth conversions, because taking money from an IRA into a Roth, the tax bills do when you make the conversion. So they like that. They like getting the money. But Congress does have people who are like, wait a second, we're not charging any tax bill on all this growth. And then later on, when this person dies, it's not taxable. And oh, by the way, it's not taxable to their kids either, who maybe inherit it. And the kids get 10 years of tax deferred growth as well. And then when they pull the money out, they don't have to pay any taxes either. A cash starved federal government is going to start looking at that in a serious way. Okay. IRAs, here you can see the IRA limits. You can see some of the catch-up provisions. Okay. Traditional deductible Roth conversion. One thing you'll want to take advantage of, especially for those of you who are higher income earners and maybe you are phased out on deductions and so on. Well, guess what? You can still contribute to a traditional IRA. You just don't get a deduction for it. And as long as the money's in the account for at least a day, you can do a Roth conversion and move it into a Roth. Okay, so the key that Roth conversion at the bottom here has no income limit, that is your friend. That is absolutely your friend. Just know the money has to go to the traditional IRA first if you're above the phase out limits. Okay, it just does. Okay, HSAs. Ken, I'll take the next couple slides here as well.
Yep.
So HSAs are kind of like 529s for your health. Okay. So an HSA, you put the money in under the age of 65. If you pull the money out for anything healthcare related, you don't pay taxes on it. So it's kind of like a Roth IRA for healthcare, right? You get over the age of 65, then you can pull the money out for any purpose and they don't care, right? So it will kind of function like a Roth IRA later on in life for you. So there are some limitations around how you can get an HSA. Your employer has to offer a certain type of plan and so on. So check with your employer to see if you're eligible to contribute to an HSA because it can help save you money on healthcare costs when you're under 65, and it can provide some tax-free money for you for a variety of purposes once you're over 65. So HSAs can be a great planning tool. Deductibility of qualified long-term care premiums. Okay, so long-term care premiums, the types of long-term care policies that qualify for this deduction are your traditional long-term care policies. What do I mean by traditional? You pay a premium and you're paying either monthly, quarterly, semi-annually, or annually into the policy. The policy covers you for long-term care only. There is no life insurance component. There is no disability component. There's no cash value that builds up in it. It is pure long-term care insurance. You can see the deductions you can get if you have that type of long-term care. Given that the planning we do is never in a bubble, I would encourage you to think carefully if you go down this road and only look at long-term care policies that qualify for the deduction. Can they do a great job from a long-term care planning standpoint? You bet they can, and they are a great tool. But there's a load of different ways you can plan for that extended care event that most likely is coming for all of us as we get older. So this is a great thing that encourages people to go get long-term care insurance. Just remember, this is traditional long-term care. It is long-term care only. Okay, no return of premiums, none of that stuff. All right, and then Medicare, and then I'll turn it back over to Ken for Social Security and wrapping up. From a Medicare premium standpoint, this goes back to something Ken said earlier about cliffs. Okay, and this happens. Like I probably have this conversation 4 or 5 times a year. Okay, so I'm gonna focus on the middle modified adjusted gross income joint column. Let me just focus on this here, right here. Oops, hold on. I hit too many options. Here we go. Okay, I'm going to focus on this column. Okay, so let's say you're in retirement and you're rolling along in this, I don't know, let me pick this one. Okay, you're rolling along right in here. You're right in the middle. Okay, and you know your total modified adjusted gross income for this means that your Part B premium per person is going to be about $400 and your Part D is going to be about $40. Okay, that's the income adjustment. Okay, so all in as a house, because your income as a household, you and your spouse, you're going to be paying about $900 a month for your Medicare premiums. Okay, you help your oldest grandchild buy their first home. And the way you did it was you took $100,000 out of your traditional IRA. Okay. I took 100,000 out. If I take 100,000 out, no matter what, no matter where I am in this bracket, I'm at least here in the 338 to 408, 404, but realistically, I am here because my income went from on the low end 268 to 368. But if I'm at 338, I went to 438. Okay. So let's say it pushed me up into this bracket. Well, here's what happens 2 years later. It's a 2 year look back. 2 years later, when I get that January Social Security statement, you're going to see the deduction for your Medicare just jumped by about $200 per month per person. And you're going to freak out because it was 2 years ago. You probably forgot what account that money came out of. Maybe you didn't really, you were so excited to help. Maybe it just didn't really sink in that that was going to be a 100% taxable event at the time you took the money out. You remembered it when you filed your income taxes the next year, right? But then you probably thought you were done. The following year, you get the Medicare bill. Okay. So this goes back to something Ken talked about. You go $1 over. That's a cliff. Okay. You go $1 over, and guess what? You're in the next bracket. And the real kicker here is it's 2 years later. So it's plenty of time to forget all about it. That's all I'll say about Medicare. Okay. Ken, what should we be thinking about my Social Security?
So this is not a tax, but if you claim Social Security early before your full retirement age of 67 and you make too much money, you get less benefit. So the government keeps more dollars and you get less. Is that a tax? Technically not. But if you make more than $24,480 and you're 62, 3, 4, 5, or 6, your Social Security will be reduced by $1 for every $2 you make over that $24,000 amount. If you are still working, and that's a really important distinction, this is earned income. Earned income, not liquidations from your IRA. So if you're working part-time at your church, if you're at the YMCA, just if it's earned income, W-2 income, and it's greater than 24,480, your Social Security benefit is reduced if you're claiming. But after you reach full retirement age, you can make all the dollars you want. Just please be strategic of when you claim your Social Security and that you're not going to reduce your benefit unintentionally. Now, this is my favorite topic, is Social Security is a tax-efficient income source. We're really going to focus again on that green married filing jointly because that applies to most individuals. Well, if your income is over $44,000, and this is your provisional income, again, a whole new equation, and it's at the bottom of the screen. But 85% of your Social Security applies to your income tax. Well, another way of saying that is that 15% of it is income tax free. Would you want that 15% to be larger or smaller? A lot of the states we work in that have a state income tax, Social Security may also be tax exempt. Would you want that dollar to be exempt on the state level, to be larger or smaller? Let's talk about it. Now, what's cool, and not every household is able to do this, but if we can manage and get your provisional income below $32,000, now again, you could still be living $100,000, $200,000, $300,000 a year lifestyle, but if it's coming from tax-free sources, it doesn't show up on this equation. It could still be a zero. All of your Social Security can also be tax-free. And again, it's one of the cool things we're able to do for some, not every household, but get more tax-free dollars. And that pays huge dividends over a retirement overall. Next slide. And all of it, everything we talked about is on this key data card. And it's available in that email that we sent out. If you'd like us to specifically send you a version of the PDF or you want to swing by and we'll print it out for you, we're available. But it's not about what you make. It's not about the growth. It's It's about what you get to keep. And so right now, all your tax documents are pouring in. This is the perfect time to collect them all. Let's talk about it. There are some things that can still be done between now and April 15th that can apply to 2025. And if you don't like what your numbers are projected like, we might be able to help adjust them. Even more so, we're now in 2026. Let's start planning for what things might be. The tax bill did get passed last year. It extended a lot of the things that were scheduled to sunset this next year. So a lot of those tax opportunities are good for at least the next 4 years. Let's build a plan together. Let's talk about it. Let's figure it out. Matt?
Thank you, Ken, and thank you everyone for joining today. I threw the schedule links for me, Ken, and Jason Dufault into the chat. So if you do want to schedule some time to review something that we talked about today, feel free, just click on the link, grab a time that works best for you. And then just in case you weren't able to pull it out of the emails that came out inviting everyone, I am dropping the PDF of the key data card um, into the chat as well. So that'll come over in just a second here. There we go. And it's all in there. So go ahead and feel free to grab that out of the chat as well. But everyone, thank you. And keep in mind what Ken said, even though it's the end of January, you still have time, right? There is still a good 2.5 month window for you to do some things that can help have a positive impact on the tax bill you're going to be paying this year. Um, if it's 3 or 4 or 5 months from now and you're feeling like there wasn't anything you could do, or maybe something changed, sold a business, sold a house, inherited some money, somebody passed away, or you got a divorce. When you have all those different things coming at you, lean on us, right? We will ask the questions to help you make sure that when that big period or time of change is happening, you don't lose sight of the financial impact, not just in terms of what's in your bank account, but like we started talking about today, what you're going to pay in taxes
Mhm.
once the dust settles.
And,
So,
and, and I'll double down as you're at the water cooler, at the gym or at work, whatever it is, and people are belly aching about their taxes, be like, let me give you my guy's card.
yeah.
Call him. Again, 20 minutes, 20-minute chat with us might save them significant dollars, headache, and heartache. It's up to them if they want to chat.
All right. Thank you, everyone. Have a great weekend. Hopefully, you're staying warm. And
Yep.
we will see you next month. Next month, I got to double check what the calendar says, but we're going to do another one of these next month. We'll be focused on, I don't know, I should know that, but we will see you all next month. Thank you again. Stay warm, and we'll talk soon.